Hey, all, welcome back. Principles Accounting 1, where we made it to week 3, which is fantastic. I know those first few weeks could always be a little bit, wonky here and there. The technology doesn't always work the way it's supposed to, and getting the LinkedIn Learning accounts all squared away and all that jazz. And just want to say thank you. I appreciate all of your efforts that you've made so far in the class. It means a lot to me, and hopefully it means a lot to you. Um, I want to say thank you again to all of you for your patience. Thank you so much for your work that you've done over the first 2 weeks. I think that you're all making great progress so far, and so I just want to say again thank you. I appreciate all of you and your efforts, especially as we make progress throughout the course. And so with that, I just want to kind of recap where we were and where we're heading. In week 1, we talked about this concept called accounting. We talked about the very basics of accounting. We talked about assets equals liabilities plus equity, which is the accounting equation. We talked about all the different types of accounts that there are. We talked about cash, accounts receivable. We talked about property, plant, and equipment, all of those things being asset accounts. We also talked about our liability accounts like accounts payable, taxes payable, wages payable, any type of payable. We also talked about short-term and long-term liabilities, things like loans and things of that nature. And then we also talked about our equity accounts. Equity is what the owners own. It's the difference between the assets and the liabilities. And the assets include things like paid in capital, um, uh, retained earnings, which is derived from sales minus expenses, equals net income. Net income gets added to retained earnings. All of those things show up on our equity. Um, and then the second week, we ran through a lot of different transactions. I showed you a ton of different transactions that we would commonly make. As you remember, each transaction is impacted is impacted. There is a debit account and a credit account with every single transaction. Uh, and the transaction impacts the accounting equation. The accounting equation always maintains its balance. And those were the things that we learned about in the second week. And also within those first and second weeks, we learned about the accounting cycle. We learned that there are about 8 steps to the accounting cycle. We identify the transaction, we uh, journalize the transaction, we post the transaction, and then we go through this process. We prepare an unadjusted trial balance, which is a list of all of the accounts identified within the chart of accounts and the respective balances, whether it's a debit or a credit balance based off of the normal balances. And that leads us to where we are this week, which is talking about making adjusting entries based off of for our financial statements. And that's what we're going to talk about today. So again, appreciate all of you and your efforts that you've made over the first 2 weeks. It's what makes the course a success, and I sincerely appreciate all of you. And of course, I appreciate all of you being here. So thank you, thank you, thank you. I also wanted to point out very quickly in the classroom, in addition to the success that you've made over the past 2 weeks, I decided to, um, over the past few months, I've been working on a tutor for you. Now, this tutor you'll find here at the very top of the classroom. I just finalized this tutor. This is a GPT model, which is an AI model that I created. specifically for this class. This is only open to students in this class. Okay. This is not a publicly available model. It is something that I created. I've given it several parameters to only focus on financial accounting topics, which are the topics that we cover in this course. This model has been trained on the content only within this course, and I designed it to act as a tutor for you. So, uh, if you don't have a ChatGPT account already, I recommend that you create one. It's free, totally free to use. You'll select this link here at the very top, and it will open up the model. This is the ChatGPT model, and this is a tutor for this class. And so the way it works is you can ask it questions related to the content in this class, and it'll walk you through as if you're a student in a class and you are working toward understanding the content a little bit further. So you might ask it something like, what is the accounting equation? And it'll go through and provide you with the accounting equation, break down each part, then it'll put it into an example for you. Okay, and then it'll ask you more questions. Would you like to try practice problems with the accounting equation? Yes, I would. And you just talk to it like it's a tutor, right? This is designed to be a tutor for you for this class. So feel free to play with it and use it to the way you best see fit. This is I made this especially for you. It is a tutor for this class only, and so I encourage you to use it. It's real simple to do. When you first, if you don't have an account, it's simple. All you do is you can either log in if you already have an existing account. I want to do that in a private window. Um, you can log in if you don't already have an account. If you already have an account, if you don't, you can quickly sign up. It's totally free to use, and this model is only for this course. It's only for you. So if you ever need any type of training related to this course, I built this for you. So please, please, I encourage you to use it whenever you see fit. If there's some type of content in this course that you do not understand, and it's like middle of night, and you're like, oh, I don't want to bother Dr. B, or it's like something that you just real quick type of question, pop it in there, and it'll most certainly give you the best results because the way that I train this model is based off of the content in this course. So please engage with it as you see fit. Any questions on that? Yeah, just it's just something I wanted to find a way to give back to you, as being a student in this course. And it took me several months to program it. I developed this GPT model from scratch. I gave it a ton of parameters. A lot of safety measures are in place. A lot of guards. So, like for example, if you try to copy and paste a question from, let's say, a quiz or whatever, it's not going to give you the direct answer. It will coach you to better understand the content related to that question. So hopefully you find this handy and please use it as a tool. That's what AI is designed to do. It's a tool for you to use to improve yourself. That's what this tool is designed to do. So please use it as you see fit and have fun with it. So it's there in the classroom for you. So thank you for that. And so without further ado, let's go ahead and jump into today's discussion on making adjusting entries and what adjusting entries are all about. So, very commonly in accounting, there comes times where we have to make adjustments based off of what is happening and when things are happening. And we do make those adjustments through what we call adjusting entries. And when I think about adjusting entries, I think about what needs to be made here and why we're making this adjustment. Now, oftentimes we make adjusting entries because uh, of there's a transaction that was made in, let's say, the middle of the month, and it carries over into the next month or into the next accounting period. Well, based off of the matching principle, we have to make an adjusting entry at the end of the month in order to recognize an expense or revenue for that month. Okay, so based off the matching principle says, hopefully you remember this from, I think, last week, week before. Matching principle says that we must recognize revenue and expenses when they were incurred. And if a transaction carries over across more than one accounting period, meaning more than 1 month, we have to make an adjusting entry at the end of that respective month in order to recognize the expense or the revenue for that month. So, in other words, it's kind of like we're breaking out into like partial transactions. And I'll explain all of this, but I just want to give you an idea of what adjusting entries are and why we make them. So, it's first really important to understand what accounting periods are. An accounting period is a month, a quarter, half of a year, or a full year. Okay? A month, a quarter, half of a year, or a full year. That represents an accounting period. If you remember, one of the concepts we talked about last week was at the end of every single month, I need to start the next month at zero on my income statement accounts. The reason for that is because I started a new month. I can't start it with existing expenses for that month because it didn't happen yet. Can't start it with revenue. Didn't sell anything yet. So I have to start each month with zero. The way I do that is through a closing process. I close out my temporary accounts to retain earnings, right? That's how that works. A month is an accounting period. A quarter is an accounting period. Half of a year is an accounting period, and a full year is an accounting period. This is important because it tells us when we recognize revenue and expenses, and it also provides us with uh, financial information about the company over periods of time. Okay, that's why these accounting periods are so important to understand. It's also important to understand this because not every business follows a calendar year as their 12 months of business. What I mean by that is when I started my business on March 1st. And so my fiscal year runs for 12 consecutive months. It starts March 1 and ends February 28th. That's my fiscal year for my business. The government's fiscal year starts September 1 and ends August 31. Okay? That's a typical government. Their fiscal year starts September 1, ends August 31. My business starts March 1, ends February 28. We call it a fiscal year. It doesn't necessarily always follow the calendar year. Make sense? That's what we call fiscal year, 12 consecutive months of operation. So, why is the calendar so important? Why is understanding that 12 months in business is so important? It's because we must recognize revenue and expenses when they were incurred. Okay? As you should know already, there are two types of accounting. The type that is most commonly used, well, the type that's recognized by the IRS, is called accrual-based accounting. Accrual-based accounting is when we recognize the revenue when the good or the service has been delivered to the customer, and we recognize expenses when they were incurred, meaning when they actually happened. Okay? That's accrual-based accounting. I'll give you an example. I made $1,000 in sales to a customer in the month of August, at the end of the month of August. Okay, so August 31, I made a $1,000 sale to a customer. I delivered the good and the service to them on this August 31. The customer didn't pay me until this week. Okay? I recognize the revenue when it was earned. And in this case, I delivered the good or the service on August 31. Therefore, I recognize the revenue in the month of August. In addition to that, I just received my Pepco electric bill just this week. And on that electric bill, it said for energy, electric, used, consumed for the month of August. It had August dates on it, August 1 to August 31. So I consumed the electric expense in August. I just received the bill just a few days ago in September. So I'm going to date that bill in my accounting system for the month of August because that is when the expense actually occurred or was incurred. Okay? That's because of the matching principle. We must match our revenue and expenses when they actually happened. Yeah. That's accrual-based accounting. We, in this class especially, use accrual-based accounting. It's very, very important to understand how accrual-based accounting works. On the other hand, some businesses use what we call cash-based accounting, and then eventually they convert their reports to accrual-based accounting for tax reasons. But with cash-based accounting, we record the sales and expenses when cash is either received or paid. Yeah, it's really, really easy. Some corner stores might use cash-based accounting. Most restaurants use cash-based accounting. If cash is the primary method of payment for the customers, they might use cash-based accounting. So they recognize sales when the cash is received, and they recognize the expenses when the cash is paid. That's the primary difference between accrual-based accounting and cash-based accounting. I'm also going to show you an example of what the effect is on the financial statements for each of these, because I want you to understand the importance between the two. First, I want to show you accrual-based accounting and what the impact is for something like prepaid insurance. As you know, a prepayment of expenses is an asset account. It's an asset because I can reclaim that expense. I can claw back what I had already paid. That's why it's an asset to me. In other words, I paid my 2 years of insurance up front in the month of December, okay? I could always cancel that policy and get a refund of the remaining balance that I have not used. Yeah, that's why it's an asset to the business. It's called a prepaid account. So here we have an example where we prepaid our insurance for 2 years. We made the payment on December 1st of 2021. All right, so take a gander at this. Here's how it works. We can see that uh, the prepayment covers the 2 years. 2 years is 24 months. It covers December 2021, all of 2022, and most of 2023, up to 24 months. You can see that I made the prepayment. So when I made the prepayment, I debited prepaid insurance and I credited cash on December 31. That was the transaction. At the end of each month, I need to recognize the consumption or use of that insurance expense. And the way that I do that is at the end of every month for that 24 months, as I debit insurance expense $100 and I credit cash. I'm sorry, I credit prepaid insurance $100 to reduce the prepayment. I've already paid for it in cash, so I wouldn't use cash again. So what I'm trying to say is that I made the prepayment December 1, 2021. Each month thereafter, I'm going to debit insurance expense and credit prepaid insurance. What that does is it recognizes the use of that insurance for each month. Does that make sense? Questions on this? We're okay. So that transaction, making the debit to insurance expense and the credit to prepaid insurance, that is called an adjusting entry. We're adjusting for the use or consumption of that prepaid insurance. Now that's accrual-based accounting. What does it look like on cash-based accounting? This is why I said that, well, a couple things. Accrued accounting is much more accurate, and it's much more accurate for reporting reasons. So take a look at this. If I used cash-based accounting, I would have an insurance expense in the month of December 2021 for $2,400. It would overstate my expenses during that month. It would make my net income for the month of December 2021, it would make it look terrible. Right? So that's why I wanted to point out that difference. Because it's super, super important that we recognize that difference between the two. So I just realized something, and I apologize. I'm going to exit this presentation real fast, and I'm going to open up the more recent version of this presentation. And the reason why I wanted to show you the older presentation first is because I felt that the older presentation actually did a better job of explaining that difference between cash and accrual-based accounting. So that's why I had the older one up. I just wanted to kind of show you that primary difference. So I'm going to go back, and that's not terribly different. Obviously, the dates are the only things that really changed. But I felt it did a better job, at least from an explanation perspective. So that's why I was showing you that older version. But here we are with the updated dates. It's all obviously all the same example, but I just wanted to show you what it looks like. Yeah. So that's accrual-based in comparison to cash-based accounting. And we can see that the primary difference, of course, is in the reporting. So the cash-based accounting, it makes it look like your expenses are much higher than they actually were, right? So that's why these also in accrual-based accounting, that's why these adjusting entries are so important because we need to recognize when the expense is actually incurred or used. So the next part I wanted to talk about after I've showed you the difference between cash and accrual-based accounting is when we recognize revenue. I had mentioned that recognizing revenue, we recognize the revenue when we have delivered the good or the service. That revenue recognition requires that the revenue is recorded when the good or the service has been delivered to the customer. That does not mean we recognize revenue when we receive cash. We recognize revenue when the good or the service has been delivered to the customer. We call that earned revenue. It's when the revenue is earned. There are times when the revenue is what we call unearned. Unearned revenue is when the customer paid us before we delivered the good or the service. That is called unearned revenue. And I'll explain that a little bit more here in a little bit. We also need to better understand when we recognize our expenses. It is important to understand that we recognize our expenses when the expense is incurred, meaning when the expense actually happened. I received my Pepco bill in September, but the bill reflected the consumption of electric, use of electric, in the month of August. So therefore, the expense belongs in the month of August. So I'll make an adjusting entry and I'll debit rent expense, credit accounts payable, and I'll date that for August. Yeah, so that way it is recognized in the month of August. So we recognize our expenses when they were incurred. This is, they also say that we recognize the expense that what we call matching the benefit. What we mean by that is it matches when the sales occurred as well. So, for example, I use electric to produce inventory, to make inventory. I use electric to run my machinery. My machinery creates inventory. I sell that inventory. Okay. So the use of electricity used to create assets to then sell to the customer, the electric expense is a direct result of the benefit of using that electric. Okay. That's what it means when you see what does it mean by benefit, right? That's what we mean by benefit. So that's when we recognize expenses. There are four instances when we would make an adjusting entry at the end of the month. One of those reasons is what we call a deferred expense. It's when the expense occurred, but we have not yet recorded it. We deferred it. We deferred recording it. The word defer means to put off, to delay, right? I'm delaying recording that expense, so I'm deferring that expense. It's common business practice when it comes to our income statement entries, and this is because some businesses like to make it look like they have more revenue, net income than what had actually occurred. Right? It's technically a legal practice. It is a legal thing to do. You can do it, um, but it's not good to do it. Okay, so deferral of expense. It's we are waiting to record the expense. So that's what deferral means. We also have deferral of revenue. What that means is that um, we made the sale, we've delivered the good or the service, so it's earned revenue, but we haven't recorded it yet. We're waiting for some reason. Okay, deferred revenue. The third reason why we would make an adjusting entry at the end of each month is called accrued expenses. For example, um, I prepaid my insurance for 2 years. At the end of each month, I've used or accrued the expense, and therefore I need to make an adjusting entry for it at the end of each month. So examples of accrued expenses are insurance, sometimes rent, if we did prepaid rent. So insurance, sometimes rent, wages. Employee worked for 2 weeks, haven't paid him yet. I accrue the wage expense. Taxes, I collected sales tax, haven't paid the sales tax yet. I accrue the tax expense. Those are accrued expenses. We make adjusting entries for those at the end of each month. And we also have accrued revenue. Uh, the customer prepaid us, meaning customer paid us in advance of delivering the good or the service. We call that unearned revenue. When we deliver the good or the service, it becomes earned revenue. So I make an adjusting entry to recognize that we earned that revenue. So debit, unearned revenue, and credit revenue. That would be the adjusting entry I would make for that. So those are the four reasons why we make adjusting entries. We do this in a three-step process. The first step is to determine what what the current account balances are. Then we determine the current account what they should be. We estimate what they should be, and then we record the adjusting entry. Yep, it's a very simple process. I'm going to walk through a bunch of them with you. So let's go ahead. The first thing we do is we're going to prepare our adjusting entries, and we're going to look at first. We'll look at deferred expenses. So deferred expenses. Deferred expenses are the expense happened, but we haven't recorded it yet. Okay, that's a deferred expense. Examples of this include prepaid insurance, prepaid rent, and supplies used. Supplies used. So let's say, for example, Crumble Cookie, one of my favorite bakery shops, the Crumble Cookie, they use supplies. They use supplies in their baking process. They use parchment paper, they use foil, they use other disposable supplies, right? So we have to recognize the use of those supplies. Those supplies are assets. Okay, it's very similar to inventory. The supplies are assets, and therefore we need to recognize when we're using those supplies to help us to generate sales. So down below, we see the T accounts. As we make our adjusting entries, we are very typically reducing our asset and increasing our expense. So for the example of prepaid insurance, we would debit insurance expense and credit prepaid insurance, just for example. So let's look at our earlier example. We prepaid our insurance for 2 years. It covered 2 months of insurance. So that first transaction we made on December 1 was we debited prepaid insurance and credited cash. At the end of December, so December 31, I make an adjusting entry. I debit insurance expense $100 and credit prepaid insurance $100. So first thing we did was we made the prepaid insurance transaction on December 1, and that's reflected here at the very bottom of the slide. Then we recognize that the two accounts that are impacted by the adjusting entry. In this case, it's insurance expense and prepaid insurance. So we debit prepaid, I'm sorry, we debit insurance expense, we credit prepaid insurance by $100. Why 100? Remember, it's for 2 years of insurance that we prepaid, which is 24 months. So we take the total prepaid amount, 2,400, divide that by 24 months, and we get $100 per month. And so we can see at the end of December, the very first month that 24 months covers, we can see that the prepaid insurance balance becomes $2,300. And it goes down by $100 every single month for that full 24 months. So that's step two. And then step three, we update our balances accordingly. And so that's what we see here. And that is the three-step process for adjusting entries. And that is the process that we do for these types of accounts. So as I had said before, we debit insurance expense, credit prepaid insurance, and we update our balances accordingly. So this is the adjusting entry that we make at the end of every month for 24 months to recognize the consumption of that entire prepaid amount. So ultimately, what this does is it helps us to reflect the actual expense that has been incurred. Yeah, that's why we make the adjusting entry. Okay, here we have an example for supplies that we're using. Just again, my favorite company, Crumble Cookies. They use parchment paper and baking sheets and all of those things that are disposable. And those are their supplies for their company. They use them to help them to generate sales, right? Because they're selling cookies. That's what their bakery is all about. In this example here that we see in front of us, we have a company that uses supplies for making various components, okay, for whatever this company is making. So here we have an example. The company purchased $9,720 worth of supplies in the month of December. Some of these supplies were used during the month of December. So we did a physical inventory count and we found that we had remaining balance or ending balance of supplies of 8,670. So we need to figure out how much supplies we actually used. So December 1, we debited supplies and credited cash to represent the purchase of those supplies. On December 31, we recognized that we used some of those supplies in the month of December. And so we need to move that to what we call supplies expense. So to do that, we debit supplies expense $1,050 and we credit supplies to recognize the consumption or use of those supplies. And that's what this example shows us here. And we can see the reflected balance update. So we said that beginning of the month we started with 9,720. End of the month we ended with 8,670. The difference between those two numbers is 1,050. So that's how you would find that amount, right? We'll just take the beginning balance minus ending balance, and that tells us how much we used. And so we make the adjusting entry, debit supplies expense, credit supplies. And this records the supplies that we actually used. That's the adjusting entry we make at the end of the month. Good so far? Yeah?
Yes.
Awesome. Very good. Cool. Let's keep rocking and rolling. Uh, Another very typical transaction adjusting entry that we make at the end of a year or a month is for what we call depreciation. Fixed assets over time lose usefulness. I'll give you a couple examples here. Uh, a building, okay? A building, a piece of machinery. These things lose their usefulness over time. Another example, a vehicle. These are all mechanical things, right? The building, the machinery, a vehicle, these are mechanical things. They lose their usefulness over time. That's just physics, right? Things break down the more we use them. The more you drive your car, you're putting on more miles and there's more wear and tear. It loses its usefulness over time. It depreciates. Okay? Depreciation reflects the loss of usefulness over time. That's what depreciation is. Okay? So in accounting, we need to recognize the loss of usefulness of those fixed assets over time. Now, it's also important to note that we only depreciate things like the buildings and the equipment. We never depreciate land. We never depreciate land. The land itself, the ground itself, the stuff that the building is sitting on, the dirt, that land is infinite. I can reuse that land. That land will always be there. I can knock the building down and put another building up. That land is still there. So therefore, we never depreciate land. Land will always be there. It is infinite. Okay, that's why in accounting we don't depreciate land. We only depreciate buildings and equipment and vehicles, if they're used for the business, and other fixed assets. So, how do we depreciate these assets? There's a couple of different ways we do this. Most commonly used way is called straight line depreciation method. This is the easiest formula, the easiest way to depreciate an asset over time. Okay, it's very, very simple. And the way that we do this is we take the total cost of the asset. So that's the purchase price of the equipment plus the cost of installation plus the cost of insurance of getting it there. We call those landed costs. That's the total cost of the asset. To keep it easy, we'll just say the purchase price of the asset. So asset cost, how much we paid for the asset, minus this thing called salvage value. Salvage value is also known as scrap value. It's whatever the asset is worth at the end of its useful life. And we divide that by useful life. Useful life is the number of years that we expect to use the asset. The number of years we expect to use the asset. Okay? Useful life is typically given to us by the IRS through what we call a maker's report, MACRS report. This maker's report that the IRS publishes every single year, it gives us an idea of how long assets should last. Right? It's kind of like a guideline. We can work within that guideline, but that's typically the amount of years that we use. So I'll give you a quick example of this. According to the IRS, my car that I use for the business should last about 5 years. I paid $25,000 for the car. At the end of its useful life, I don't think I'll be able to sell it for anything, so we'll say it's worth zero at the end. So 25,000 purchase price of the vehicle minus 0 salvage value divided by the 5 years means I have a depreciation expense every year for 5 years of $5,000. Okay? That's the straight line depreciation method. I'm going to show you in another example of how this process works. So here we have an example. Our company purchased a piece of equipment December 1 for $26,000. Remember, the dates are important. We purchased it for $26,000. It has an estimated useful life of 5 years. We expect that the equipment will be worth about $8,000 at the end of its useful life. In other words, its salvage value is $8,000. We purchased the piece of equipment on December 1, but now here we are at the end of the year, December 31. And we have to recognize the depreciation for that 1 month, for that 31 days. Okay? So we go through the process of what we call straight line depreciation. We're going to take the 26,000 purchase price minus the salvage value, 8,000. Then we're going to divide that by 5 years. So what does it look like? 26,000 minus the 8,000 gets us to 18,000. We take that 18,000, divide that by the 5 years, and that gets us to 18,000 divided by the, the 18,000 divided by the 5 years, or 60 months, gets us to $300 per month. So what that means is we need to recognize the depreciation of $300 at the end of December. Now, the way that we do that is we're going to make the adjusting journal entry at the end of December. Now, I wanted to quickly show you how that works because it's important to understand that we never take away the value of the asset directly from the asset. What I mean by that is on the balance sheet, it's always going to show as that equipment is $18,000. It's always going to show that every year. Okay? We don't pull the depreciation directly out of the asset. We credit an account called accumulated depreciation. This accumulated depreciation account is called a contra asset account. It shows up on your balance sheet as having a credit balance. This is an asset account that has a credit balance. It's the only one that has a credit balance. It's called a contra account. Contradictive to the asset. Contra account. Accumulated depreciation is a contra flow or contradictory contra account. Okay? So that's why it holds a credit balance normally, because we never, ever, ever depreciate directly from the asset. So what we do is we're going to debit depreciation expense by that $300, and we're going to credit what we call accumulated depreciation by the $300. It's contra account to that equipment. Okay? That's why we call it a contra account. So here's that journal entry again. We debit depreciation expense, credit accumulated depreciation at the end of every month for a total of 60 months. Okay. So once again, accumulated depreciation is a contra account to the fixed asset account. So in this case, equipment. That is how we track the depreciation for that asset. And we do that for all fixed assets, meaning all your buildings, all of your equipment, all of your vehicles, that type of stuff, but never land. All right. So, fast forward a couple of months, February 28 rolls by. We've been using that new piece of equipment now for 3 months. Last year, we recognized 1 month of depreciation. So end of December, it was $300 depreciation. So we debited depreciation expense and credited accumulated depreciation for 300. Now here we are 2 months later, February 28. Now what happened was at the end of each month, I made that same adjusting entry. I debited $300 depreciation expense and credited accumulated depreciation, 300 every single month. So 3 months total has gone by. Now, what that means is that your total accumulated depreciation on your balance sheet in your contra account should show a balance of $900. So, in order for us to determine what the book value or the value of that asset is at the end of any month, is we take the cost of the asset and we subtract out the accumulated depreciation amount. That gets us to what we call the book value or the value of the equipment. Make sense? Or any questions about this depreciation process? Depreciation can sometimes be very tricky, so I want to make sure that you all understand it. We good?
Yeah, I'm good.
Awesome. Thank you so much. Appreciate that. Great. Very cool. Okay, so let's move forward. So we talked about deferred expenses, which were the things we just talked about. Now let's talk about deferred revenue. Deferred revenue. Deferred revenue is unearned. We recognize revenue when the revenue is earned. We recognize revenue when the revenue is earned. We earn revenue by delivering the good or the service to the customer. That's the only time we recognize revenue as being earned. It's unearned revenue if we received cash before delivering the good or the service to the customer. We oftentimes call this deferred revenue or unearned revenue. Right? Unearned revenue or deferred revenue is a liability. It's a liability because if I don't deliver the good or the service to the customer, I have to pay them back. Right? That's why it's a liability. So, for us to recognize that revenue as being earned when we deliver the good or the service to the customer, we debit unearned revenue to decrease that liability, and we credit revenue to recognize the revenue. So here we have an example. A customer paid us a 60-day consulting fee in advance of us providing the consulting services. All right, so we need to recognize the amount that has been earned at the end of the year. The customer paid us on December 26th. This is for consulting services between December 27th through February 24th. So first I make the recognizing that we receive cash from the customer. So I debit cash and I credit the liability account unearned revenue for the amount of 3,000 because that's what the total consulting services were for. Now, a few days have gone by, and here we are at the end of the year. I need to make an adjusting entry to recognize that I earned revenue for those few days. This 27, 28, 29, 30, 31. Okay, so 5 days went by, and I earned revenue for those 5 days. End of the month, I need to recognize the amount of revenue that I earned during that month. In this case, it's 5 days worth of revenue. So I need to calculate how much revenue that is. And the way that I do that is I realize that the entire service contract is for 60 days and 5 days has been earned. So I take I take the amount of time and I multiply that by the principal amount, in this case, $3,000. The amount of time is reflected as 5 days over the total of 60 days for the contract. So 5 over 60. So I take the fraction 5 over 60 times $3,000, and that gives me a total of $250 earned revenue in the month of December. So once I realize that I've earned $250 in the month of December, I make the adjusting entry. I debit unearned revenue, $250, and I credit revenue, $250. And we can see that those balances reflected on our T accounts. We can see that unearned revenue went down by the 250 and consulting revenue went up by the 250. And that's what this T account shows us. So once again, here's that transaction that I made at the end of December. And I would make a similar adjusting entry at the end of each month. So end of January, the amount will be, of course, much larger because that's a whole 30 days in January. And then the remaining number of days, of course, will be recognized in February. So as we earn the revenue, we debit unearned revenue, credit consulting revenue. Those are the adjusting entries. So that is an example of deferred revenue. The next area of adjusting entries that we look at is called accrued expenses. Accrued expenses are the costs incurred in the accounting period that have been both unpaid and unrecorded. Unpaid and unrecorded. We call that accrued expenses. Example of this would be my employees. My employees typically work for 2 weeks and then I pay them. Yeah, very, very normal. It's normal to get paid every 2 weeks. And so I got employees, they work for the 2 weeks, and then eventually I have to pay them. We accrue their wages, right? I accrue their wage expense, and then I have to pay them. Wages payable. So they worked, but I haven't recorded that expense yet. So I need to make an adjusting entry to record that expense. Accrued expenses, typically it's for things like wages, but it can also include things like rent expense, taxes, and interest. So let's walk through an example of our employees that have worked for the 2 weeks, but I haven't paid them yet. Okay, so here we have an example. We have an employee that earns $70 a day or $350 for a 5-day work week. Obviously they're part-time. So we pay them every 2 weeks on a Friday. So at the end of the year, December 31. It happens to land on a Wednesday. All right. So I need to recognize the wage expense for that year. And in this case, it's only been 3 days: Monday, Tuesday, and Wednesday. That's because the year ended on Wednesday or the month ended on Wednesday. So I need to recognize the expense for that month or for that year. So in this case, I need to figure out what the salaries expense is going to be for those 3 days. I take their daily rate, in this case $70 per day, and I multiply that by 3 days. In this case, it's $210. So I need to make an adjusting entry at the end of the month. And in this case, I debit salaries expense 210 and I credit salaries payable 210. But I can hear you. Well, Dr. B, there's a couple more days in the week. We got 2 more days left in the week. Remember, we recognize the expense for the month. I can't go into to January with already wage expense. That's why we make these adjusting entries. But don't worry, we're going to pay our employee properly. So we will accrue that additional 2 days, but we'll do that in the month of January. So based off of that adjusting entry, here we can see the effect on our accounts. We see that salaries expense went up by the 210 and salaries payable went up by the 210. So as I had mentioned, our employee worked for the 3 days. They obviously they worked for 5 days, and so I need to accrue the rest of those expenses. So end of December, the accrued salaries was $210. Now here we are in the next year, and they worked the additional 7 days, those 2 days plus the next 5 days. Okay, so I need to recognize that expense. So that's 7 days times the $70 per day gets us at $490. Then on January 9, I'm paying my employee for their time worked, the 10 days. So I debit salaries payable that I already accrued back in December. I debit salaries expense that I accrued in January, and I credit cash, the $700 to pay the employee. That is a very classic example of accrued expenses. Pretty much all of our accrued expenses work the same way. This one just so happened to be wages. You could do the same thing for things like rent, taxes, and insurance. So now let's move into the fourth category, which is the accrued revenue. Accrued revenue is the revenue that we've earned during the accounting period, but we have not yet recorded it and we have not yet been paid by our customer. In other words, I delivered the good or the service, but I've not yet recorded the revenue as being recognized, and I have not yet received the cash from my customer. Okay? That we call it accrued revenue. And the way that we recognize this revenue is that we would debit accounts receivable because the customer has not yet paid us, and we would credit revenue to recognize the revenue. So remember, accrued revenue is when we earn the revenue, but we have not yet been paid and we have not yet recorded the revenue as being earned. So here we have an example of this. We made a sale to our customer. We've delivered the service. On December 12th, customer agreed to pay us $2,700. On January 10th is when they're going to pay us. And that is for the next, that's for service being provided over 30 days. Well, we know that if we started this contract on December 12th, by December 31, 20 days had passed, right? So we need to recognize the revenue that we earned during those 20 days. And the way that we do that is we take the contract of amount, which is 2,700, we multiply that by the time. In this case, 20 over 30 days, because it's a 30-day contract. So 20 days accrued over the 30 days. So we take 20 over 30 and then we multiply that by the 2,700. That gets us $1,800. So we debit accounts receivable $1,800 and we credit consulting revenue $1,800 to recognize the revenue earned at the end of the year, for that month. The effect on the accounts is that consulting revenue went up by 1,800 and accounts receivable went up by 1,800. So debit accounts receivable, credit consulting revenue. And then, of course, as you know, there is an additional 10 days remaining on the contract. So the way that we recognize those additional 10 days is we're, of course, going to add that to the existing 20. The way we do that is through this entry. We debit the cash that we receive from the customer on January 10th. That's after the whole 30 days had passed. So we debit cash 2,700. We credit the account receivable that was accrued for that 20 days to reduce that account receivable, 1,800. And then we recognize the rest of the revenue by crediting consulting revenue for 10 days of that revenue, which is really just the difference between the cash received minus the 20 days that we've already accrued. In this case, it's $900. That's how we recognize our accrued revenues, by making those types of adjusting entries. So this slide here is a nice recap slide. I like this because it gives you the effects on the accounts, and it's just a really good summary slide. So definitely you'll find this slide useful as you are working on your quiz for this week. So after we have made our adjusting entries, we can then make our adjusted trial balance. Last week, we learned how to do the unadjusted trial balance. Last week, we learned how to do the unadjusted trial balance. As you recall, the unadjusted trial balance is a list of all of your accounts that the company uses in order that they show up on the chart of accounts. All of your asset accounts start with 100. All of your liability accounts start with 200. All of your equity accounts start with 300. Your revenue is 400. Your expenses are 500 and 600 and so on. We list them out in that order. Assets, then liabilities, then your equity accounts, then revenue, then expenses. Those accounts normally have either a debit or credit balance. Assets normally have a debit balance. Liabilities normally have a credit balance. Your equity will either have a debit or a credit balance depending on what it is. And your revenue is always going to have a credit balance. Your expenses will always have a debit balance. We identify all of those balances for all those accounts. In the unadjusted trial balance, the reason why we prepare that is because we want to make sure that our total debits equal our total credits. Then we've made our adjusting entries. The adjusting entries help us to then prepare what we call the adjusted trial balance. The adjusted trial balance is the unadjusted amount plus or minus the adjustment that had occurred, the adjusting entries that we had occurred. That gives us the adjusted trial balance amounts. So, for example, accounts receivable, our unadjusted trial balance was zero. We made an adjusting entry, increasing accounts receivable by 1,800, giving us an adjusted trial balance of 1,800 for accounts receivable. Another example here could be let's see, supplies. We started our supplies with $9,720 debit balance. We made an adjusting entry because we ended up using $1,050 worth of supplies. That gave us an adjusted trial balance amount of $8,670 for supplies. So that's the purpose of the unadjusted trial balance. Then we make the adjusting entries, which gives us the adjusted trial balance amounts. And as you can see at the very bottom, our total debits equal our total credits, which means that we've done it accurately. Now, once we've prepared our adjusted trial balance, we can then prepare our income statement, balance sheet, statement of cash flows, and statement of retained earnings. We do this based off of those balances that we've discovered within the adjusted trial balance. So we go through the steps. First thing we do is income statement. Then we do statement of equity, statement of owner's equity, also known as statement of retained earnings. Then we do our balance sheet, and lastly, we do our statement of cash flows. All of those balances coming from our adjusted trial balance. So as you can see in this slide, we have our prepared financial statements. First, we did income statement, then this statement of retained earnings, then our balance sheet, and then our statement of cash flows. All of those balances are reflective of the balances that came from our trial balance, adjusted trial balance. That's the process. So you've learned a lot today about our adjusting entries and the purpose of those adjusting entries. Of course, one of the last things I need to give you is a ratio. I know how much you love ratios. They're your favorite. You're like, Dr. B, I wish you could give us more of them. They're the best. I agree with you. Yeah. One of my favorite ratios is called the profit margin ratio. Love this ratio because, and it's super important in business because it measures the company's net income at relationship to its sales, which tells us how much profit is being generated from each sales dollar. Yeah, very super important ratio, very easy to calculate. We take net income and we divide that by sales, by net sales. And here we can see in comparison Visa and MasterCard as companies, Visa's profit margin 53% for the current year. MasterCard's was only 45%. So, which tells us that Visa is making a 10% larger, well, 8% larger profit than MasterCard is. Yeah. Interesting information. It's a great way to compare companies. And then very briefly, I just wanted to show you the difference between accrual and cash-based accounting just a little bit more. We've already talked about this, but this just kind of recaps what we talked about. On the left side, we can see, I'm sorry, that on the top side, we can see the cash-based accounting. On the bottom, we can see the accrual-based accounting. We've made the transaction, debit, prepaid, insurance, credit, cash. That's for the accrual-based accounting. And then we see the adjusting entries there at the bottom. Cash-based accounting, we're just simply debiting the insurance expense and crediting cash. We can see the effect on those T accounts based off of that transaction being reflected based off the adjusting entries made at the end of each month. And we can also see a comparison with respect to our revenues. If it's a cash-based system, it's real simple. It's just debit, cash, credit, consulting revenue. For our accrual-based accounting, We debit the cash, credit unearned revenue, and then we recognize the revenue as it's being earned. So just wanted to just recap that for you. So we've reached the end of our discussion today on making adjusting entries. Just to kind of remind you of what is due for this week, um, we simply have the Chapter 3 quiz. So real simple, yeah? So uh, if you need any help, you have any questions, whatever it is, you can email me, call me, set up office hours. You also have the new GPT model that I've created for you to assist you in any tutoring that you may need. But regardless, I am always going to be here for you. I'm always going to support you in your efforts, and I promise you that I will always stand by you in everything that you need. So, with that, are there any last minute comments, questions, or concerns? We're good? This is great.
I am.
Awesome. Love it. I love it. Okay, thank you all so very much for your time today. I sincerely appreciate all of your efforts and your time. Remember, we do not meet this coming Thursday, so I would like you to use that class time to complete your Chapter 3 quiz. I promise you, if you do that, it will put you into a good position and you won't feel stressed on Sunday night trying to figure it all out. So, again, thank you all so much for your time. I really appreciate all of you, and I hope you have an awesome rest of your night. Thank you so much.
Thank you, Dr. B. You
Thank
too.
you.
Have a
Thanks,
good night.
Dr. B. Good night.